Hi everybody, this is Alan Ellman, the Blue Collar Investor. In this video, I'm going to demonstrate how we could use the Premium Stock Report to develop a portfolio of $100,000 and how to populate that portfolio with particular securities. Now, our Premium Stock Report has a huge amount of information, and that information can be tailored to your specific needs and risk tolerance. In today's video, I'm going to use one particular way to use that report, but I'm going to ask you not to restrict yourself to use this particular way, but rather to tailor the report to your specific needs. Now, in order to dictate how to populate this particular portfolio, we need to set up some parameters. So let's start with the following parameters. First of all, as I said, in this hypothetical portfolio, we're going to have $100,000 cash to spend on the securities. That means we want to have a minimum of 6 to 8 different stocks to be appropriately diversified. Not only stock diversification, but industry diversification as well. In addition to that, we want to be appropriately allocated as far as the cash dedicated to each position. So, for example, if we have 6 stocks and a $100,000 portfolio, we want to allocate approximately $16,000 per position. And finally, we want to make sure that the options associated with these securities will generate the kind of returns that will meet our goal, in my case, 2 to 4% a month for my initial return. So that being said, let's now turn to our Premium Stock Report, and in particular, pages 2 to 3 of the report. Page 1 has a summary of the Exchange Traded Fund report our members have received earlier in the week. It also summarizes the economic reports of the week and gives our overall market assessment. So the actual screening starts on pages 2 and 3. And you can see at the very top of the page is the actual screening process as set up in the BCI methodology and found in my books and DVDs. And that includes fundamental screens, technical screens, as well as common sense parameters like minimum trading volume. Now, if you take a look at the price column, that gives the most recent price as of market close on Friday prior to the publication of this report. Now, if we're going to have 6 stocks and $16,000 per position, what that means is, since we have to purchase 100 shares of stock to sell one contract, that the price per share must be $160 or less. So any securities trading well above 160, we're going to eliminate. For example, take a look at the stock 3 rows from the top, Biogen, ticker BIIB. That security was trading at $347.11. Much too expensive for this particular portfolio, so we're going to eliminate all securities trading well above $160 per share. Now, once we've done that, the pool of stocks we're selecting from the report will decrease somewhat. And next we're going to turn to what I consider the meat and potatoes of the Premium Stock Report, which is our running list, which is somewhere in the middle of the report. And in the screenshot in front of you, you will see a typical running list on the right side of the page. You'll notice that some of the rows at the top are in gold. Those are the stocks that have passed our screens, except they have earnings reports coming out prior to expiration of the contract. So those stocks are not eligible until the earnings reports pass. Below that, you see many stocks in white cells. All those stocks, whether they're in bold or not, are eligible for our covered call writing portfolio that particular month. And if you scroll down further, there are many other securities in the white cells, and then below those are securities in pink cells, which are securities that were eligible the previous weeks, but not this week because they failed 1 or more screens. So what we're going to do here is concentrate on all the securities in the white cells. Now, to get our portfolio to a manageable 6 to 8 stocks, we're going to have to set up some additional criteria to eliminate some of these stocks in the white cells. And here we have the additional criteria we're going to use in this hypothetical portfolio, keeping in mind that this is just one way to use the premium stock report. We will start actually with the stocks in bold, even though we could use the others. Every month, my portfolio consists of stocks both in bold and not in bold, but I have way more than 6 to 8 stocks in my portfolio. So in this case, we will start off with the stocks in bold. We will also ask our securities to be in industries that are ranked A or B. So not only will we have elite performing stocks, but those stocks will be in elite performing industries as well. As we said before, the share price should be $160 or less. We also want to make sure the options associated with those stocks have adequate liquidity. And we look at the open interest of the option, and we require an open interest of at least 100 contracts. And that information, by the way, is found in our premium stock reports. You do not have to go to another resource to locate the open interest for the options on the stocks that have passed our screens. It's right there in the report. So once we've used both sets of criteria, we've eliminated it down to the stocks that you see on the screenshot in front of you now, and we look at the options chain to see if the calculations will meet our goal. Now, you'll notice here that we've highlighted some of the rows, and that's because a couple of the stocks have industry duplication. So, for example, the pink rows are stocks in the medical field, and yellow rows are stocks in the software industry. So we don't want to duplicate industry, so we will select only one stock from the medical industry and only one stock from the software industry. Now, if we were very bullish on the market, we would consider stocks like NTCT and CBM, the 2250 or 25 strike. Let's have a look at CBM, the 2250 strike, 4 rows from the bottom. With the stock trading at 21.77, we sell the 2250 out of the money strike, and we generate a premium of $1.10. That represents a 5.1% 1-month return, with the possibility of an additional 3.4% if the price of the stock does in fact move from 21.77 up to the 2250 strike, giving us a possible 1-month return of 8.5%. Now, if we were bearish on the overall market, we would look at stocks like MANH, CBM, the 20 strike, or MYGN, the $36 call. Since we looked at CBM out of the money bullish, let's take a look at CBM in the money bearish, the $20 strike, 5 rows from the bottom. And we could see that that premium generated $255, which represented 3.9% of time value, a very, very nice 1-month return, and 8.1% downside protection. So what that means is we are guaranteed a 3.9% 1-month return as long as share value does not decline by more than 8.1% by expiration Friday. So there you have it. If you're bullish, you're going to go with the out-of-the-money strikes, and if you're bearish, you're going to look at the in-the-money strikes, making sure that the initial time value return, or ROE, meets your goal, as I said in my case, 2 to 4% a month. Now, in this particular portfolio, we're going to assume that we are bullish in our positions. So in the current screenshot, you could see the stocks that we selected. NTCT, the 40 call, AEIS, 30 call, ICON, the 40 strike, IACI, the 75 strike, CBM, the 2250, and finally MEOH, the 65 call. The column to the right shows the return on the option, the ROE, meeting our goals of 2 to 4%, and then the upside potential by selling an out-of-the-money strike. And all 6 of those stocks are in different industries, so we have great stock and industry diversification, along with all the calculations meeting our goals. So next we have to determine how many shares we're going to purchase, how many contracts we're going to sell, and what our return is for the month, at least our initial return. So here's how you calculate that. We know we want to purchase shares in 100 share increments, and we know we're allocating approximately $16,000 per position. take the price per share in the case of NTCT on the top row, that's 37.05, divide that into 16,000, round it off to the nearest 100, and that means we're going to purchase 400 shares. The column to the right of the number of shares we're going to purchase is the actual cost to purchase those shares. You can see that ranges from high 14s to low 19. So although they're not precisely 16,000, they're all in the ballpark, and no one position is going to outweigh the others by a significant amount. The column to the right of that is the number of contracts sold, which is simply dictated by the number of shares purchased. So if you purchase 400 shares, you're going to sell 4 contracts. You purchase 700 shares, you're going to sell 7 contracts. And the column to the far right is how much cash is generated from the sale of those options. And you can see if you tally that up, it comes to a total of $28.50 as far as our initial options profit. And the cost to purchase those shares was $97,241, excluding about $100 in commission. So our total 1-month return for our initial profit is 2.93%, meeting our 2 to 4% goal. In addition to that, we have a cash balance of $27.59, which we could use if we need to execute any exit strategies, a critical part of the BCI methodology detailed in my books and DVDs. So once we've established our positions, we immediately go into management mode, and we're ready to initiate an exit strategy in case the price of the stock goes way down or way up, or if we have dividend or expiration issues. All that information is detailed in my books and DVDs. So there you have it. That's one way, and only one way, of using our premium stock report to populate a portfolio of $100,000 cash. For more information on premium membership and premium stock reports, go to my website, thebluecollarinvestor.com, and click on the link you see on the screenshot in front of you. There's more information there and a few more videos as well. So there you have it. Thank you so much for watching this video. I hope you found it useful. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.